All right, welcome to this explainer. Today we're unpacking the massive, and I mean massive, global consensus around India's economic boom. Look, there is a ton of hype out there right now, so today we're going to cut right through the noise. We're keeping it strictly to the facts, the very real risks, and the exact mechanical steps for U.S. investors who are looking to get involved.
So before you put a single dollar to work, here is our game plan. We've got the growth story, the critical risks, top ETF picks, broader emerging market options, and we'll cap it off with portfolio allocation and taxes.
To put this in perspective, right now, developed nations like the U.S. are growing at maybe 2% a year. Germany is at a sluggish 0.4%, and Japan is barely keeping its head above zero. But there is this incredible global consensus. We're talking everyone from the IMF to the World Bank, independently projecting India's GDP to expand by over 6.2 to 6.6% by 2026. India is quite literally the fastest growing major economy in the world.
Okay, section 1, the India growth story. Let's look under the hood at the actual structural drivers fueling this massive expansion to see if it's really sustainable. This right here is India's biggest engine, hands down. It's a sheer demographic advantage. India has a median age of just 28 years old. Compare that to the US at 38, Germany at 46, and Japan way up at 49. Because of this incredibly young population, they're adding roughly 10 to 12 million workers to their labor force every single year. That basically guarantees rising domestic consumption for literally decades to come. And it's not just a young workforce holding this up. Their digital infrastructure is honestly staggering. Have you heard of their Unified Payments Interface, or UPI? It processes over 15 billion digital transactions a month. 15 billion! Add in major supply chain shifts from giants like Apple and Samsung setting up manufacturing there, plus a middle class that's projected to explode from 300 to 500 million people by 2030. You are looking at massive, sustained demand. Right, moving on to section 2. Risks you must know. It's time to hit the brakes a bit because investing in emerging markets carries severe risks that a lot of people just conveniently ignore.
This is the absolute crucial disconnect you need to internalize. Huge GDP growth does not automatically equal massive stock market returns for U.S. investors. Just look at the last 10 years. INDA, which is the largest India ETF, returned a solid 117%. Not bad, right? But the S&P 500 returned 241%. So even though India's economy grew much faster than America's, the Indian stock market significantly underperformed the U.S. market for American investors. So why the disconnect? Well, a huge piece of that puzzle is currency risk. When you invest in an Indian ETF, your returns are tethered to the US dollar to Indian rupee exchange rate. Historically, the rupee depreciates against the dollar by about 3 to 4% every single year. It's like walking up a down escalator. Even if your Indian stocks go up in value, that weakening rupee is an invisible headwind that directly eats away at your actual portfolio gains. And it doesn't stop there. You've got to have the stomach for wild volatility in emerging markets. India has seen brutal 50 to 60% market drawdowns during global crises. There's also heavy concentration risk. The INDA fund, for instance, is almost 30% concentrated just in the financial sector. Toss in some serious geopolitical vulnerabilities, like a contested border with China and a high dependence on imported energy that makes them super vulnerable to Middle East conflicts. You absolutely need a long 5 to 7 year time horizon if you're going to ride these waves out. Okay, section 3, top India-focused ETFs. If you've weighed those risks and you still want in, let's talk about the synthesis of how you actually mechanically buy this exposure. Mechanically, getting in is incredibly accessible. You absolutely do not need to open some complicated foreign bank account, and you don't need to convert your own currency. It's super straightforward. You just log into your regular US brokerage, your Fidelity, your Schwab, your Vanguard, search for the ETF ticker, check out the fact sheet, and you place your buy order in US dollars exactly like you're buying a share of Apple. And then you hold on for the long haul. Comparing the heavy hitters here, INDA is your standard, broad default, tracking about 165 companies by size. NYD gets you concentrated exposure to just the 50 absolute biggest blue-chip companies. But check out EPI. It uses a smart beta approach. Instead of just organizing by company size, it weights over 400 companies based on their actual earnings and profitability. Now, it does have the highest expense ratio, that annual percentage fee you pay, but historically it also yielded the highest 10-year returns of the group at 153%. Let's jump to section 4, broad emerging market options.
Because maybe a single country bet is just a bit too spicy or concentrated for your taste.
Thankfully, there's a really great diluted backdoor into the Indian market. Broad emerging market funds, like Vanguard's VWO, spread your bet across about 24 different countries. But significantly, India still makes up a solid 20 to 22% of that overall pie. So you get India alongside countries like China, Taiwan, and Brazil, which drastically softens your single country risk. If India specifically takes off, you still capture a big chunk of that upside, but with a much wider safety net. Finally, let's wrap up with Section 5, Portfolio Allocation and Taxes. Let's set some practical guardrails for exactly how much of this belongs in your portfolio. The golden rule here is limits. You really shouldn't allocate more than 10% of your total portfolio to a single emerging market. If you're conservative, keep it between 0 and 3% using a broad fund like VWO. Moderate investors might look at 3 to 7% with a dedicated ETF like INDA. And aggressive is capping out at 7 to 10% maximum. Always remember, your core U.S. portfolio, your S&P 500, has to remain your foundation. India is a geographic diversifier. It is not a replacement. Now, here is a really critical, practical tip when it comes to taxes. Foreign funds often withhold taxes on your dividends, which causes double taxation. As a U.S. investor, you can claim a foreign tax credit to offset that. But here is the catch. You can only use this credit if you hold the ETF in a standard taxable brokerage account. If you hide the fund inside a tax-advantaged account like a Roth IRA where taxes are already deferred, you completely lose that credit benefit. As you're digesting all these numbers, I really want to leave you with this quote. India is a bet on future outperformance, not confirmed past outperformance. Taking your portfolio global requires serious patience, clear eyes, and a deep understanding that the economic hype of the world's fastest-growing economy still has to survive the gritty mechanical realities of investing, like currency headwinds and massive market volatility. So where do you land? After seeing that brilliant demographic upside, the massive digital scale, right alongside those very sobering currency risks laid out in front of you, what's your play? Are you ready to actually add India to your portfolio? Or is the historical safety and dominance of the U.S. market more than enough for you? Think about how these facts fit your own strategy. Thanks so much for joining me on this explainer, and I can't wait to dive into our next topic with you.